everyone, happy April. It's Natasha Bridgmohan here at the Financial Room, your host, president of the Bridge Group of Companies and your specialized mortgage broker with Monarch Mortgages. Today's topic, we're going to be talking about saving you money and understanding contractual agreements when it comes to mortgage penalties. Now, there is some unfair practices right now that is happening in our Canadian mortgage market with lenders charging penalties different ways, and sometimes charging a client 5 times more in terms of penalties. So we're going to talk to you about mortgage penalties and how it's calculated and how to understand the differences. Now, everyone wants a good mortgage rate. Everyone wants the lowest mortgage rate. But sometimes getting the lowest mortgage rate ends up being the most expensive mortgage product that you'll ever get. And one of those reasons why sometimes getting a really, really low mortgage rate ends up to be very expensive is because if you see the need to break your mortgage and you would have to pay penalties, sometimes those penalties that borrowers incur, they have to pay sometimes 5 times more than their other lenders' counterparts, where the same borrower may have the same mortgage amount or same mortgage rate, and they're paying $1,000 and you end up paying $5,000. How does that happen? How does 2 borrowers have the same mortgage amount, the same interest rate, the same mortgage maturity date, and they both break their mortgage the same day, but they're with 2 different lenders, and one penalty is $1,000 and the other one pays a penalty of $5,000? So how does that really happen? Well, very, very simple. First of all, it's very important for you to have a great mortgage broker team on your side to educate you on those fine print that really doesn't really get clarity from your mortgage banker. So mortgage penalties, how are they calculated? They're calculated in 3 different ways. The first way is very simple, 3 months interest penalty. So if your mortgage payments is $1,000 and you break your mortgage, if it's $1,000 every month, your penalty should be about $3,000. Simple. But the fine line says 3 months interest, or IRD, which simply means interest rate differential, whichever one, wait for it, is higher. Now, IRD is calculated either by the contract rate or the posted rate. And this is where there is a vast difference, where some borrowers become victims of the interest rate differential method of unfair practice by some lenders. Yes, it's legal. Yes, it's by the book, but it's really not practical or fair to impose these higher penalties that's not necessarily paid by other borrowers. So, very simple. Interest rate. If your interest rate is 5% today, and the bank, you break your mortgage today and the bank is offering a contract rate at 4.5%, they're losing 0.5% interest. So what you pay is the interest rate differential for the remaining of your mortgage maturity term of the loss of the 0.5% interest income your lender would impose. So it is fair for a lender to charge you a penalty if you sign a contract and it's a closed mortgage. They have to re-lend that money out and there's administration fees. But the most expensive interest rate differential is the other version, where the bank will use their posted rate. And if their posted rate is 3%, then the interest rate and your regular rate is 5%. There's a 2% margin. And that is where you pay up to 5 times more penalty, where the bank uses the posted rate calculation. So be wary, my friends, of what you're signing. Understand your mortgage clauses and terms and conditions. Speak up. When in doubt, spit it out. Ask your mortgage broker team. This is where we're here for. We're here to help you. We're here to educate you. We're here to save you thousands of dollars in respect to mortgage penalties. Pick up the phone and call us 1-866-553-7467, my friends. That's 1-866-553-7467, and save the date for our annual picnic, Saturday, June 15th. Stay tuned for more information. Take care.